Most people think the world ends with a bang, but in October 1973, it ended with a click. The click of a closed sign hanging on a gas pump. The click of a furnace that finally went cold. For 30 years, we lived in what historians call the long boom. We built an empire on $3 a barrel oil. We designed our cities, our cars, and our entire way of life around the assumption that cheap energy would flow forever. We were a nation of V8 engines and suburban dreams, but we were building on sand. In the blink of an eye, the Yom Kippur War turned the lights out. OPEC, the group that controls the world's oil, didn't just raise prices, they cut the cord. They launched an embargo that didn't just shake the West, it brought the global engine to a grinding, screeching halt. If you were standing in those mile-long gas lines back then, you weren't just waiting for fuel. You were watching the death of the old world and the birth of a terrifying new reality. To understand why 1973 was so explosive, we have to look back 2 years earlier to the summer of 1971. For decades, the global financial system was anchored by the Bretton Woods Agreement. Every dollar was backed by gold. It was the golden anchor that kept inflation in check. But the costs of the Vietnam War and rising social spending were draining the U.S. gold vaults. In August of '71, President Richard Nixon closed the gold window. He ended the direct convertibility of the U.S. dollar into gold. Overnight, the world moved to a fiat system, money backed by nothing but the promise of the government. This was the structural crack in the architecture. The dollar began to lose its value, and the oil-producing nations in the Middle East noticed. They were being paid for their black gold in paper dollars that were worth less every single day. The tension was building. The embargo wasn't just about a war in Israel. It was a rebellion against a weakening dollar. On October 6, 1973, the holiest day of the Jewish calendar, a coalition of Arab states led by Egypt and Syria launched a massive surprise attack on Israel. The world held its breath as the Cold War superpowers were pulled in. The Soviet Union backed the Arab coalition. The United States backed Israel. When the U.S. approved a $2.2 billion emergency military aid package for Israel, the Arab oil-producing nations struck back. They didn't use tanks or planes. They used the oil weapon. They announced a total halt of oil shipments to the U.S. and the Netherlands. The architecture of the global economy was built for flow. It was never designed for a stop. Within weeks, the price of a barrel of oil quadrupled. It rocketed from $3 to a staggering $12 in 90 days. Imagine if your monthly rent or your grocery bill quadrupled in 3 months. That was the scale of the shock. As energy costs soared, something happened that shouldn't have been possible according to the textbooks of the time. We entered the era of stagflation. For half a century, economists believed in the Phillips curve. It suggested a simple trade-off. If you had high inflation, you usually had low unemployment because the economy was hot. If you had a recession, prices were supposed to drop. But '73 broke the curve. Suddenly, we had a toxic cocktail: high unemployment, stagnant growth, and skyrocketing inflation, all at once. This was the three-headed monster. Every time a business tried to grow, the cost of electricity and shipping ate their profits. Every time a worker got a raise, the price of bread and milk rose even faster. The stock market reacted with pure terror. Between 1973 and late '74, the S&P 500 didn't just dip, it crumbled. It was the most brutal decline since the Great Depression. The market collapsed by 43%, wiping out over $500 billion in shareholder wealth. For the American investor, the American dream felt like it was being liquidated. If you were standing in the middle of that wreckage in 1973, watching your stock portfolio crumble by 43%, you would have been desperate for a lifeboat. So, what actually worked? What was the golden hedge? History shows us that when paper burns, tangible value wins. While the Dow Jones was falling over 32%, gold was the undisputed champion. Freshly liberated from its 35-ounce peg, it didn't just rise, it exploded. In the 13 months following the embargo, gold prices surged by a staggering 115%. It was the ultimate insurance policy against a system that seemed to be coming apart at the seams. But the real architectural cheat code was energy itself. As oil prices quadrupled from $2.90 to nearly $12, the companies that controlled the flow became the new kings of the market. While the rest of the S&P was bleeding out, oil service giants like Halliburton and Schlumberger thrived. Investors who pivoted into black gold and raw commodities saw silver jump 180% and metal prices rise 83% across the board. The lesson was clear. In a supply shock world, you don't want to own the promise of money. You want to own the stuff the world can't live without. But here is why we are talking about this today on Weekly Asset Architect. The 1973 crisis was a painful click of a closing pump, but it wasn't just an ending. It was a catalyst for human ingenuity. That crisis forced us to build more efficient cars, explore renewable energy, and rethink how we protect our family's wealth. Every market crash is a story of a system being tested, but it's also a story of a system being improved. Today we see familiar cracks, massive debt and geopolitical swings, but unlike 1973, we have the benefit of history. We know how the hedge works. We know that by building a portfolio with a solid foundation of tangible assets and energy-smart investments, we don't have to fear the next click. The architecture of your future isn't written in the headlines of today. It's built by the lessons you learned from yesterday. We study the day the engine seized, not to be afraid of the dark, but to make sure we're the ones holding the light. If you want to understand where the markets are going tomorrow, you have to understand the story behind them today. Because while the players change, the patterns, they tend to repeat. Don't just survive the cycle, build through it. If you found value in this deep dive, hit that subscribe button and join us as we uncover the architecture of money and power. We don't just report what happened, we uncover why it matters and how you can win next time. I'm the Weekly Asset Architect. Build well, and we'll see you in the next one.